The market is going up. It seems like there's optimism everywhere, but that doesn't mean that every stock is a good buy, especially if you're thinking more than just a few days or hours out like I am. I'm a long-term investor, and there are a few stocks that are very popular on the market that I think investors need to really think twice about, owning, and I think are great sells right now given their valuation and given their position in the market. That's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. The first stock is Trump Media and Technology Group. This is a real chart. This is a real chart in blue showing the revenue for the business and the losses in orange. Net income or net losses is what you see in orange. So this is a company that has an $8.3 billion market cap and has generated $3.8 million in revenue over the past year. So basically no revenue. I'm not really sure what you're buying with this business. You're buying hype. It may be some sort of social statement to buy shares or something like that, but that is not what drives value to investors long term. Memes are great, but stocks as memes don't end up adding value and don't end up lasting for very long. So if you think you could just buy this stock and get out before everybody else, well, that's the exact same idea that everybody else has. So I think this is a stock to absolutely avoid and stay away from because there's no fundamental business behind it. The things that drive stock values long term is revenue growing, is net income and free cash flow increasing. What does your profitability look like? At this point, the Trump Media Company, or Truth Social, doesn't have any of those things. It doesn't have a critical mass of users. It doesn't have the advertisers it needs. It's not generating revenue. There's no real business there. And yet there's a market cap of over $8 billion. That's something to absolutely stay away from. I don't think this should be debated. And I think it's crazy that the stock is even trading in public markets. But here we are. Pretty easy call for me to say this is a stock to stay away from. The second one is maybe going to be a little bit more controversial. That is Rivian. Rivian has an $11.4 billion market cap, and yet look at these losses that it generated. This is the free cash flow from Rivian, losing $5.6 billion. That's how much cash they're burning on an annualized basis over the past year. There are a few challenges for Rivian. One is the company just simply doesn't have enough production capacity to get to profitability. There's 215,000 units of capacity in their Normal, Illinois facility. That's where they're building R1 and RDV. They're also going to be building the R2 vehicle there. That's not going to launch for another 2 years from today. They have $4 billion worth of operating expenses on an annualized basis. That means that they're going to have to make almost $19,000 per vehicle in gross profit to cover their operating expenses. Maybe they can cut that. Maybe the number cuts almost in half. Maybe they only have to make $10,000 in profit. If they're going to be selling vehicles for $40,000 or $50,000 and need to generate a $10,000 profit, they would be one of the most profitable automakers in the world. And there's nothing to demonstrate that they're going to be able to do that. Those are margins higher than Tesla generates, higher than GM, higher than Ford. Those are Ferrari type margins. And I just don't think that there's any way that Rivian is going to get there. What they need to do is they need to build their Georgia facility, but they don't have the cash to do that. And this is the catch-22 that Rivian finds itself in. It doesn't have enough capacity to get to profitability with the existing manufacturing infrastructure. It doesn't have the funds to build the next manufacturing plant, which would cost about $5 billion. At the same time, more and more competition is coming into the market. And this is really what I think we're seeing with Rivian today. Competitors are coming in, undercutting them on price. That has led to demand problems. They've had excess supply of vehicles. They've cut back their own production. And still, they're not profitable. So all of these things are bad signs for Rivian. The stock continues to hold up relatively well, $11 billion market cap, which makes it one of the biggest automakers in the world. But there's nothing operationally that shows that Rivian is ever going to get to profitability. And that's the fundamental problem, and eventually that will make its way to the stock price. The next stock is related and very similar story. That is ChargePoint. ChargePoint is an electric vehicle manufacturer. They also build some of their own electric vehicle network and infrastructure. There's some SaaS products that they sell behind that. But the financials in this company are absolutely terrible, and it's hard to see things getting any better. This chart, I think, really shows the story. The orange in this chart is the company's operating revenue. So operating revenue growing really nicely. But Blue is what they're generating in gross profit. So that's going to be the profit that you're making from each unit of sales. So if you're making a charger and selling it to somebody, what's the actual profit you get to keep? Relatively low margin there. But here's the problem in the purple column, that is operating expenses. Those operating expenses need to be lower than gross profit. They're nowhere near that right now. In fact, gross profit is declining and operating expenses are going up. Those things are moving in the wrong direction. And there's really nothing to say that this is going to change for ChargePoint. The company is running out of money. Electric vehicle chargers are getting commoditized as the North American charging standards is becoming the standard for a lot of vehicle manufacturers. So that means there's going to be no real difference between a ChargePoint plug and any other sort of plug. And the automakers are commoditizing these electric vehicle chargers. Sure, they want to have a network that anyone can access, but they're not going to say, hey, we're going to only rely on the ChargePoint network. They're going to pull in as many chargers into their charging network that they're providing to their customers as they possibly can. So this is the fundamental problem. You have a commodity product moving a commodity, which is electricity, into a commodity plug that ultimately ends up in vehicles. That is a recipe for disaster from an investment perspective, and I think ChargePoint is going to continue to decline. Do not see a bright future for this company. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The final stock is one that I have been critical of for years. That is Plug Power. The company has been promising to be adjusted EBITDA positive, free cash flow positive for a decade now. And none of those things have come true. I want to show a couple of charts. You could look at the company's revenue chart and say, oh, wow, this is a growth company. I should be really interested in this stock. But then you add things like gross profits. How much are you making on each unit of sales? Just like ChargePoint. They're losing money on everything that they sell in this blue column. Everything. Net income, even worse. This has been the case for decades for Plug Power. The company has never been profitable, never lived up to its own expectations. And how does it fund the business? Well, it sells stock. Year after year after year, the company's shares outstanding increase. Yes, revenue continues to grow, but the stock continues to get diluted. And that's how the company stays in operations. There's just no evidence that that's going to change anytime soon for Plug Power. Anything that is potentially bullish for the company is something that you could have said 7 or 8 years ago as well. Right now, the market cap, $2.6 billion. I'm not sure when the market is eventually going to give up on this company, but this is absolutely not one that I would be buying. I would be getting out of this stock as fast as I possibly can. So the thing you see in common with each one of these companies is they're losing money, they're burning through cash, and there's not a real clear path to profitability for them long term. That's what you want to see as an investor is how is the company going to be more profitable in the future than they are today? If there's no easy answer to that, then just avoid the stock, sell it altogether. So that's what I think we should be doing with Truth Social, with Rivian, ChargePoint, and Plug Power. I think these are all stocks to avoid or sell today. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.